me to welcome President Honohan, or Governor Honohan, to the podium. Please, the podium is yours.
Thank you very much. I'm going to start with a paradox and then partially resolve it. But in the end, although maybe I don't think I will be as completely sanguine or I can see some problems. I think that what I'm going to say is not going to be inconsistent with what Steve is saying in the overall. The global imbalances was the topic that was assigned to me, and I realized, Patrick, you don't actually spend an awful lot of your week thinking about global imbalances, and that's a message too. That we don't. We worry about the euro area, and there's a reason for that, because we have a mandate which is actually about the euro area, and it's not explicitly about global imbalances. And I would have to say that global imbalance is not really a big focus of the discussion. Of course, as I'll make clear, a lot of things need to get taken into account in our monetary policy decisions. The paradox, maybe it's not such a big paradox, a funny thing has happened in the relationship between monetary policy and international macroeconomic imbalances. Overall, flow imbalances, balance of payments, deficits, and surpluses have tended to shrink globally. Out of all the countries, put all the surplus countries on this side, all the deficit countries on that side, and track through that graph contracts. I was going to show you those graphs, but then I realized that the best ones are the ones that are produced by the IMF, and that's October, and that's a long time ago. And something has happened to the oil price, something has happened, lots of things have happened, and I'm not sure those are quite up to date, but I think we can draw the qualitative conclusions from them just the same, and anyway, you're very familiar with those pictures. Remember when we all agreed that risk pricing was too low, but the event 10 years ago that many feared was a sudden stop on the US deficit. That was the big issue we were talking about. All of that stuff has shrunk. Nevertheless, qualitatively, we're in the same sort of territory in terms of who is the likely creditor country and who is the likely debtor country in the years to come. At least for the debtor country. The US remains a deficit country, and indeed it is the likely large deficit area for the years ahead. Other countries' surpluses and deficits have shrunk, but the US deficit, projecting out for the next several years, is very persistent. And the euro area emerges as a very persistent, likely surplus area for the next number of years. And in fact, if you cancel out all the other countries, net other countries, you get a rather small number. And if I do that on those IMF projections, the US deficit as a percentage of global GDP is sort of flat after 2019, and the EU is what they give in those figures, but the euro area would also be a substantial surplus, not quite as big as the US. The net of the rest of the world is also positive. Okay, there's nothing new in the US being a deficit area, and the euro area's surplus is dominated by Germany and the Netherlands, so nothing new there either. Indeed, if you look back over 50, 60 years, the US deficit and the German surplus are among the most persistent national flow imbalances in history, with the exception of Germany, of course, of the post-unification decade of the 1990s. That was a deficit period, and Germany became the largest surplus country in the world in 2013. And actually, as a percentage of GDP, Germany showed no narrowing of its surplus 2006 to 2013, that period of time. So the same would be true of the Netherlands. Now, grouping countries to provide dichotomies is a game you can play, because there are a lot of countries and you can cancel out all the other countries. But let's persist with this particular dichotomy. And the point of the paradox is that the current and prospective trend in monetary policy is the opposite to what you might expect at first sight. So you say, oh, well, we've got a deficit area over here, and then we've got a surplus area there. Probably the deficit country should be depreciating, and the surplus country should be appreciating if you were thinking in currency terms. So that's the little paradox. But it is kind of curious. So to the extent that real exchange rate movements are a mechanism for international adjustment, especially through the effect on expenditure shifting, so that's what you would expect. Euro area exports, lower imports, maintaining growth, increasing euro surplus, and the opposite for the dollar. So you might think, and although I insist that the exchange rate is not a focus of the policy, but if you just happen to look at exchange rate moves, you might think, to the extent that they reflect recent and prospective monetary policy action, that there's some kind of paradox, and that they're somehow exacerbating global flow payments imbalances. So there's the paradox. But let's the rest of what I'm going to say is sort of unpicking that. First of all, the actual real exchange rate movements over the last number of years has been really rather small. Expenditure shifting hasn't been major contribution to the narrowing of the flow imbalances that happened for various reasons. U.S. always gets the safe haven flows in various areas of the euro area. The other point to bear in mind on global imbalances, these are global flow imbalances. Well, what about stock imbalances? I won't say much about those, but let's remember there are many, many dimensions to global imbalances. We normally just focus on the current account because it is the most important. There are stock imbalances, and those stock imbalances are growing. Flow imbalances are shrinking, but they're still in the same general direction, and so we have an increase in stock imbalances. But these are affected not only by the momentum of flow, but by valuation effects. Exchanges come into equity prices, defaults, and that's hard to predict. So I won't say too much about that, but bear in mind that there are many types of global imbalances. And there are other imbalances which are also relevant in the global context. Gross indebtedness is important. There are so many parts of the world, and certainly of the euro area, where indebtedness and over-indebtedness is a major drag in the economy. That's also something that needs to be fixed. And there are internal, sectoral, and regional and national imbalances that have global consequences. And then the question is monetary policy, and are the current monetary policy actions helping those and helping redress those other dimensions of imbalances, even though at first sight they might seem to be going in the wrong direction for the global flow imbalances. And perhaps they're not even going in the wrong direction for flow imbalances if we consider transmission mechanisms other than expenditure shifting through pricing changes. Aggregate demand is a key part of this story. If aggregate demand is too weak in the euro area or parts of the euro area, is euro area monetary policy actually going to help that? Is it going to help it sufficiently? And there are a number of dimensions to this. One of the dimensions is the fact that we can see a considerable risk appetite in the financial sphere. Investors prepared to go into all sorts of products for the sake of yield, but relatively little risk-taking in the real sector. And you can understand why that is. There's option value of weighting, maybe much more considerable when you're talking about a real physical fixed capital formation, something like that, whereas the option value of weighting for a particular financial investment may not be so high. In the case of households, the debt overhang, is that something that can be addressed through measures of quantitative easing? Now, this brings me to the whole question of the instruments of monetary policy. Because there's a tendency for us to say that, well, monetary policy is a little like a hammer. It's just one thing you can do. Actually, with the hammer you can go like that, or with one of those claw hammers you can go like that to take the nail out. So I don't know which way you think of it. I think of this one as bashing down inflation, and the other one, when inflation went down too low, you're trying to get at the nail and pull it out. It's not as easy. You can be inaccurate with the hammer. You can hit the hammer too hard, or you can. Well, but this stuff requires a lot of careful positioning and skill. But anyway, I don't think that monetary policy is any more just one-dimensional like that, in or out. when we talk about non-standard, we've been talking about non-standard instruments for the last 7 years, but we're also at zero lower bounds, so they become relatively more important. And so what is it? What are we trying to do with our non-standard instruments to get at those other dimensions of imbalance correction that might not be directly to do with the flow current account and expenditure shifting? We've started the quantitative easing in the euro area at a time quite different, I think, to when it was the configuration of interest rates and spread. Low interest rate spreads, low credit spreads, low term spreads. So we're in different territory. So you have to be very, very refined to get action out of this QE. And what we've been doing and prioritising from the ECB's point of view is we've been looking at the assets that are less richly priced and saying, wait a minute, well, bank loans, they're not richly priced. We see a great paucity of bank loans. Is there some way that the assets that are correlated or that are built out of bank loans, that they can get a fuller price through asset purchases by the ECB? And that's where the asset-backed securities program, the covered bonds program, that while we started with those, that's where the mispricing, if this mispricing is more likely to be there. And let's not, in all the enthusiasm and excitement about the move to buying sovereigns, let's not forget the importance of those programs. They can be slow burners. Actually, they could, in quantitative terms, they could add up to almost, say, a fifth. Depending on how it goes, it could add up to a fifth of the program in quantitative terms. And those measures are measures that can help boost private demand, private investment demand. And to the extent that the overall program gets that inflation rate back up to where we want it to be, it can reduce the degree to which undershoot of inflation is adding to the debt overhang. So those slightly more subtle effects of monetary policy than the usual raise interest rates, inflation is high, and so forth, are going to help that demand situation in Europe and indirectly help the global flow imbalances, but also the other imbalances that affect the global economy. So I think I'll stop at that point.